was found written on the wall in Mother Teresa's home for children in Calcutta. It's based on the Paradoxical Commandments by Kent M. Keith. It says this. It says, people are often unreasonable, irrational, and self-centered. Forgive them anyway. If you are kind, people may accuse you of selfish, ulterior motives. Be kind anyway. If you are successful, you will win some unfaithful men, friends, and some genuine enemies. Succeed anyway. If you are honest and sincere, people may deceive you. Be honest and sincere anyway. What you spend years creating, others could destroy overnight. Create anyway. If you find serenity and happiness, some may be jealous. Be happy anyway. The good you do today will often be forgotten. Do good anyway. Give the best you have, and it will never be enough. Give your best anyway. In the final analysis, it is between you and God. It was never between you and them anyway. I like that thought. Okay, a couple of things. Your book, your personal financial binders are due today. The last 5 minutes of class will let us out just a little bit early, and then I'll have one person in that door, and I'll be on this door. And all we want to do is we just want to see the tabs. We want to see that you've got in fact, can I see yours and use yours as an example, Austin? So all I'm going to check is see if you have the tabs. The tabs are printed and not handwritten, and they're not numbered. We're going to look and see if you have a picture that says personal financial plan. Yours doesn't have to say Austin Brown on it. And then I always sit here and I try to figure out where the picture was taken. And about 3 times in the whole class I can figure it out. And then I'd like to also see just the table of contents, just so what happens is once we grade something here, we'll also put the answer on here that we've graded it as well. No, just print it out. Print it out and put your name on it. And some of you are still I've got emails over this weekend about people looking for the tabs. It's going to take a couple of days, so Thursday we'll finish off the rest. So we'll get some of them done today. And for some people who couldn't quite find the tabs or something, Austin, thank you. If you just go outside my room, they're just pinned to the outside there so people could come by and grab those. And then once you're done, if you could hand me back the blank ones. So if you took one, just hand back a blank one, and then what I do is I print them up for the next class. Okay, I also wanted to talk a little bit about the service teaching. We all know that we have 4 hours of service teaching. One change I'm going to make this semester is if you're married or engaged, I strongly suggest you come to the Investment Banking Club is having they're the Money-Wise seminars, but we're calling them a personal finance boot camp. It's 3 2-hour sessions of personal finance. Starts on Wednesday, the 6th of February, and it'll be 3 successive Wednesday nights. I'll teach the first 2 hours. We've got a CPA and a financial planner teaching the second and third hour, and then Jacob Sabrowski from Utah Valley University will teach you the third 2 hours. But if you'll come to those with your spouse, I'll give you 3 of your 4 service hours. Now, if you decide you don't have to do those things, and remember you can also write articles for that International Family Initiative. But if not, I want you to do service teaching. Melissa said it was okay that I use this as an example. But with the service teaching, you talk about it's 4 hours. It's 4 separate hours, somewhere between 45 minutes and an hour and 10 minutes of teaching. But you need to come up with a plan what you're going to teach, which is generally in your PowerPoints. So she's got her topic was on goal setting, and she taught her husband. And so here's kind of the things that she taught. Now, you're welcome to take anything we have on the website, anything on the CDs that's mine. It's freely shareable. It's a lot easier to edit someone else's work than it is to think of it from scratch. So we encourage you to do that, and then just change it. And then what I like to do is like to look how you changed it, because often I find good ideas. You know, you changed it better than what I could. And so she's got, here's what she taught, how her preparation was, what were the results of that, and what would she change. And then on the back of that, we have the slides. Okay, questions on the service teaching? And if you hand these in before they're due, and these aren't due till the end, what we'll do is we'll pre-grade them for you and hand it back. If you don't get full credit, we'll tell you what you need to do to get full credit. So we encourage you to hand those in. if you, yes?
So you encourage married people to go to that seminar,
Right.
and single people go, so that
Oh, yeah. So, but you have to go to all three. So bring a boyfriend. You know, bring Elliot. You know, you know. So if you'd like to do that, my point is for most of you who are single, you're getting all those presentations and more in the class. So it's, if you come, realize when you come to that, you're not coming to listen. You're coming to be the mentor. So if you come with your spouse is listening, and you're the mentor. So I'll talk for 50 minutes, and then we'll have 10 minutes of Q&A. And as the mentors, you guys will walk around, answer questions. Then I'll talk for another 15 minutes, and then we'll have 15 minutes of Q&A, and you guys will walk around, just answer questions of the students. And so I'm hoping there'll be a couple of hundred people there, so you guys will get good opportunities to answer questions and to help the other students that are there. And I'm recommending, I'm kind of the lead for the asset management track. I'm recommending everyone in the asset management track come and take it. It's only 6 hours, but we'll hit kind of the key things. Goals, we'll hit goals, budgets, emergency funds, savings, insurance, just some basic things there too. Okay, questions? Does that make sense? Okay, and like I said, I'm changing it this time to try to encourage, spouses to go. And hopefully what it'll do is pique, if you're married, it'll pique the interest of your spouses to maybe read up a little bit more. I watched the first video there. I was sitting down in the back of my chair. We were reading scriptures, and my daughter walked behind me, and she goes, "Dad, I'm sure glad you're tall." And I thought, every time they make comments like this, I'm always interested. And I said, "So why?" She goes, "That way people can't see the bald spot on the back of your head." So, you see all the things you do, and you see not putting your tie up, or your tie all the way through. But as you go through and see those, maybe you can speed them up a little bit, but at least it may pique some interest for spouses to try to understand a little bit more. So hopefully you can pique some interest, and hopefully those classes will be able to help. Okay. Let's talk a little bit about what we're going to do today. We're going to talk a little bit about tax planning, the tax process. I'm not going to spend as much time on the major tax features. You can kind of read that on your own. Let's talk about what's due for your financial plan. Section 5 is on taxes. So the first question is, what tax form and tax strategies did you use last year? So for most of you here, it's going to be easy. It's going to be 1040 EZ. What was your marginal and average tax rates? And we'll talk about that. Your marginal tax rate is what's the tax rate on each additional dollar. And that'll come from your tax tables. Your average tax rate is you add up all your taxes paid divided by how much you made. And average tax rates can be on a couple of things. It can be on gross income. It can be on taxable income, and we'll tell you what. Your action plan is what tax form and tax strategies should you use this year. Most of you are seniors who are graduating. You will likely use a different strategy. And then what else can and should you do to reduce your tax bill to Uncle Sam? And I say for a given level of income. Someone made a comment. He says, "I can just quit working. It reduces my tax bill," and that's not quite what we're trying to encourage. So reduce your tax bill for a given level of income, and that's kind of our framework. So let's start with a question. In your groups, how important are taxes? So the two questions: how important are taxes? And what areas are influenced by taxes? Let's take 1 minute in our groups, just kind of answer those. Okay. So how important are taxes? How important are they? It's a 7. What's your largest single expense for the year generally? Probably taxes. So if you figure it's like a third of most people, that's more than mortgages and things like that. Maybe we ask the question, what areas are influenced by taxes? Why don't we just repeat some of those? Influenced by taxes? Pardon me? Business? Other areas influenced by taxes? Education? Retirement? Investment? Healthcare? Pardon me? Security? Budget? Transportation? Housing? Maybe a harder question, is there any area that's not influenced by taxes? So, some other things pardon me? Donations or charity is influenced. Life and death. Look at insurance. You can't even die without taxes. I can't even think of any areas that are not influenced by taxes. Kids, taxes, deductions. That's how important the topic is. What have our leaders said about taxes? Now, why don't you divide into your groups and spend a minute? Well, let me step back. How important have taxes always been an integral part of our history? Anyone been to Nauvoo? Did you ever notice anyone go into all these old houses there? Did you ever notice the size of the closets in Nauvoo? Guess the size of the closets. If you notice them, they're only like 14 inches. Any idea why those closets were only 14 inches? 15 inches was considered a room, and it was taxed differently. A lot of people back in Joseph Smith's times, they'd build their houses on a county line. Joseph Smith's dad did the same. Why did they build their houses right on the county line? So you could pay the lower taxes of those. We actually know which side of the house Joseph was built in. Joseph was born in just because built. Born in. Because we know, because it was on that part of the county line. But it's interesting, taxes have had an impact. So let's take a minute and say, what have our leaders said about taxes? Take 1 minute, talk about it in our groups. So what have our leaders said? Emily, what have our leaders said about taxes? Shh. Yeah. Okay. Follow the laws of the land. Other things, other people, our leaders have said. One time there was a group of people who actually said, well, since the income tax law wasn't in the original Constitution, we didn't have to pay it. And the church came down really hard. We are members of this, our nation, And we are required to obey the laws of the land. And the people who obey the laws of God should also obey the laws of the land. And so the church always does that. The church follows the laws of the land wherever the church is. And that's an important thing. Of course, how many people do you think actually pay more taxes than they should? A lot of people. I lived in Arlington, Virginia, and there was 2 bridges. There's the Washington Bridge, and then there's the 66 Bridge. I could pay a toll and cross into Washington, D.C., or I could drive another 5 miles and go across for free. The choice was up to me. And that's why I say we pay everything that's due and not a penny more. And so that's kind of what we're talking about today. Anyone heard of a term called Tax Freedom Day? What's Tax Freedom Day?
Is that the day you can, like, you work enough for that day that you don't pay more taxes?
Right. That's the day that you stop working for Uncle Sam and you start working for yourself. What do you think is going to happen in 2012? When's Tax Freedom Day? Are we going to be paying more taxes or less taxes in 2012? More. So Tax Freedom Day is probably going to be, it's going to be moving up. But if you take into account all the taxes we pay, April, you're not working for yourself till almost after April. So that's scary. That's a scary thing. Let's talk a little bit about the tax process. And we're talking about the federal tax process. And so let's kind of go through this framework here. So it starts with income from all sources, less exclusions and deferrals. And we'll talk about some of those exclusions and deferrals. And it's called gross income, not because it's very small, but that's just the term for it. And then what we do is we subtract adjustments to gross income, or they're also called AGI deductions, and it gives us our adjusted gross income. The third thing we do is we subtract the greater of the standard or itemized deductions. And so the government really gives us a couple of options. We can either itemize, or we can take the standard deduction. And the standard deduction is the government in all of its wisdom says that the average family should have this amount. Then we get minus our exemptions, which gives us our taxable income. Then we look up our tax in the tax table. And that tells us what our tentative tax is. We look at minus any credits. That gives us our total tax owed minus any taxes paid, gives us either a refund or a balance due amount. So that's kind of our framework. So let's kind of go through and let's talk about each of these things. So gross income. Again, all income unless specifically excluded or deferred. Let's say you have a 401k. You've got a 401k, a traditional 401k. So when you put that money in, let's say you put $5,000 in, notice contributions to qualified retirement accounts, that is an exclusion to your income. So you make $50,000, you put $5,000 in there. That $5,000 you put in your qualified retirement plan, your 401k, is an exclusion. So life insurance proceed grants not in excess of college expenses. You get a grant for school. For $5,000, your college expenses are $10,000, so that's an exclusion from your net income. However, if you get grants of $15,000 and your college expenses are only $10,000, then $5,000 of that would be included as income. Municipal bond interest. High net worth people like to have muni bond interest because they don't have to pay federal taxes on it. So that is an exclusion. And I have kids, we have 529 savings plans for my kids' education. And then the interest on that savings vehicle is considered an exclusion. Now it's kind of interesting. Qualified retirement plan, a 401k is considered an exclusion, but interest on an individual retirement account is called an adjustment. So these are gross income. These are our exclusions. Deferrals include like-kind exchanges, things like that. So the first is gross income, and now we have adjustments to get our adjusted gross income. So contributions to individual retirement accounts are an adjustment to your gross income. Qualified medical savings contributions. I went in Saturday and I had my teeth worked on and I had my eyes checked. And I paid for that with a Benny card. I have anyone know what a flexible spending account is? You know, and this is just the one we use. And so what am I doing using flexible spending? I'm paying for my medical expenses with what? Yeah, before tax dollars. And so money we put into qualified medical savings contributions or flexible spending accounts, that is an adjustment. Now the downside is last year they allowed us to put $5,000 into those flexible spending accounts. Anyone know what the limit is this year? $2,500. I can tell these people don't have many kids. Contribution to health savings accounts, student loan interest and tuition and fees deductions. Again, adjustments to your gross income, 1/2 your self-employment tax. And also losses. You know, if you've got capital losses on investments and things like that, you can deduct up to $3,000. So we started with gross income. We talked about exclusions, deferrals. Now these are adjustments. Okay, and that gives you your adjusted gross income. And now what we do is we get to decide, do we want to take a standard deduction or we can take an itemized deduction? When would we do one over the other? Yeah, whichever one's better. And I found that once I bought a house, paying tithing generally wasn't enough to kick me to the itemized deduction, but once I bought the house, since then, I've never used a standard deduction. So be wise on that, and so make sure you understand it, because it can be substantial. So the standard deduction, it's an IRS allowed reduction to get your taxable income. Notice that it kind of goes up every year, right? Now in 2012, it is $11,900. So the government, in all of its wisdom, assumes that the average family will have $11,900 in expenses, and so they allow you to deduct that from that process. Now you can also do itemized deductions. So you can keep records, and if your itemized deductions are greater than the standard, you use that because it allows you to pay less taxes. Charitable contributions, cash, in-kind, and or mileage. Anyone here a scoutmaster or work with young women? You know, if you keep that mileage there, you don't. It's not a lot, but it still helps out for miles that you don't get reimbursed for. Charitable contributions, your donations. I actually pay for my kids' mission expenses with appreciated securities, and that's called a donation in kind. And I still get the full deduction for their home mortgage interest. Now, medical expenses, what does this mean greater than 7.5% of AGI? Yes?
Any medical expenses you have that are greater than that 7.5% of what your adjusted gross income is,
Right.
you can add to the itemized.
Right. And it's Seth, right? So anything, the government assumes you will probably have some medical expenses. So I've got a child who's sick today. You know, we had a lot of other medical expenses too. As long as it's less than 7.5% of AGI, they assume that you'll cover that in your normal income. Anything beyond that, you are allowed to deduct that. Unreimbursed qualified job expenses, again, if it's reimbursed, you don't get to do that, but unreimbursed, and again, greater than 2%. Casualty and theft expenses, greater than 10% of AGI. Either state and local taxes, local general sales tax, property taxes, principal residence, and things like that. So you're allowed to deduct those things. And then realize mileage deductions vary. So charitable mileage for a Boy Scout or a young woman's leader or things like that, it's 14 cents a mile. Business, notice business is 55 cents a mile. Notice that moving or medical expenses is 23 cents a mile. You can actually see how those numbers have changed. So, yes, Mike?
Can you explain that a little bit better? Does charitable mean driving a church? Does medical expense mean going to the doctor?
Okay, so let's talk about this. If it's something you would normally do as part of your Sunday activities, the answer is no. I was on a high council where I had to go twice a week to Oakland for that, which is over and above what a normal thing, and so I was able to deduct those miles. Scoutmasters, young women's leaders who go up to girls' camp and don't get reimbursed for the miles. You can. The important thing is you just keep a record, and I just keep a record in my journal. You know, went to X Scout camp. It was 65 miles each way, you know, and we can just kind of keep a record there. Moving expenses, you have to move farther than a certain number of miles, and it has to be non-reimbursed. If they reimburse, you don't get that benefit. Do I have accountants here? They're like 50 miles. Yeah, something like that. Yeah. And then we've got exemptions. Exemption is the amount of money set aside for each person that you can deduct for each qualifying person in your household. If you're married with 4 young children at home, you have 6 exemptions. You know, and there's certain requirements that they have to be in your house for a certain number of months for the year to qualify for that. And you can actually see that that's gone up, 3,500 up to right now it's about 3,800. We had my father-in-law living with us. He lived with us like 9 of the last 12 months before he passed away, but because of the months, he left for a couple of months and we didn't quite get the deduction, but that's okay. We still had fun. Enjoyed having him with us. And then once you do that, you actually come down to the tax tables. And notice that the tax tables, between the way that they're set up, between 0 and 17,400, you pay 0 on the first thing, and then you pay 10% of that amount between there. And then between 17,400 and 7,700, you pay 17,400. Excuse me, you pay 1,740 and 15% on the exit, the difference between this and this, between what you spent and that amount. So notice that the 1,740 is just 10% of this. 9,735 is 10% of that plus 15% of that difference. And that's kind of the way the tax tables work. And we talked about your marginal tax rates. If your taxable income is $65,000, what is your marginal tax rate? 15%. If you made $15,000, your marginal tax rate is 10%. So this is where we get those marginal tax rates that we talk about. Credits. What's better, a deduction or a credit? A credit. So what is a credit? It's a dollar for dollar reduction in taxes. Significantly more than deductions. They're either refundable, which means that they pay back to the taxpayer even if it's more than the taxes that were paid, or non-refundable, which means that you only pay back up to the amount of taxes were paid. Refundable include reduction earned income, taxes withheld on wages, estimated income tax payments, non-refundable child tax, child dependent care, elderly and disabled, adoption, hope learning, and lifetime learning. So realize there are a number of credits. Hopefully this is up to date. For tax credits for students, and realize income limits apply. Earned income tax credit, American Opportunity Tax Credit, lifetime learning credit, tuition and fees deductions. So the good news, how many people here work with the VITA Lab? There's a number of people here. Look at these people here because they're the ones. One of the neatest things is you, as students, you can go up and you can sign up. Is it online? You can sign up online, and then you can work with tax students here who are very good at what they did. I tried to get them to help me out, but because I'm a professor, they wouldn't. But I encourage you to do that. At some point in the future, I'd actually like to do something similar to that with personal finance, that you guys would staff that. I think it would be a neat thing. Okay, so that's the process. Gross income minus exclusions and deferrals gives us, and then we've got adjusted gross income. We subtract out some of the adjustments. That gives us our adjusted gross income. And then we subtract either the standard deduction or the itemized deduction. And then that gives us, then we subtract out our exemptions, and that gives us our taxable income. We look up the taxable income in the tax table, and that gives how much tax we owed. We look at what we've paid, and then that gives us the amount that's due. Now, my tax students here, please don't read too much in. Don't worry about AMT. Our tax students here tend to go way beyond what we're doing here. We're just doing very basic stuff here. So based on what we've talked about, think about this. What are some strategies we can use to reduce our income? Reduce our tax bill. Why don't we take just a couple of minutes? And if you're lucky enough to have some tax people in your group, they can give you some good ideas. Okay, so based on this, what strategies, what things can we do to reduce our taxes? Yeah, I had a child that was born on December 29th. I call that good tax planning. So kids, of course, they're a little bit more expensive later on, you know, when they go on college and admissions and things like that. Okay.
So, would a child count as a tax credit, or do that?
Right, so it's an exemption for you, and it also works as kids. So it's an exemption, and also part of your child tax credit as well. It's $1,000 per child. Other things we can do. Yes.
Get married.
Get married.
Quit running good ads.
So there's certain benefits there where you can reduce that. Other thoughts? Yes?
Say keep good records so you can keep track of all the
Good records. Anyone donate to things like Mothers Against Drug Writing and SAD and things like that? My wife does that. And so what's the best way to record these types of things? What's the best way to pay on these type of donations, which are 501c3 organizations? Yep.
They have to give you a receipt.
Right, so get a receipt, but you can also pay for it with a check, and then you also have the check as a receipt too. And the nice thing, what I do is I pay for it with a check, and then I also in Quicken I just put it on charitable donations, and I've got a number of categories under charitable donations. And then I'm getting ready to work on my taxes here, and I'll just print off my charitable donations, and I'll just write them down. So keeping good records is really important. Other things? Yes?
You can donate with securities. Donate
Yeah.
to the church or anything with securities.
So I generally pay my tithes and offerings with appreciated securities. Why don't I want to pay with securities that haven't appreciated? Let's say I paid $10 for the securities, and it's worth $15 now. How much of that is exposed for capital gains tax? What do I have to pay capital gains taxes on? $5. What happens if I take that security and I donate it in kind to the church or to United Way or things like that? How much taxes do I pay on it? And do I get the full amount for the deduction? And the answer is yes. So Learning Tool 8 allows you to do that. Yes?
Does the church just then immediately sell them? Or is it
Yeah. Well, does it matter what the church does with
Well, I
it?
was just wondering.
My guess is they'd probably just kind of sell it out. Yes?
Does the church have to pay any kind of taxes on that?
What kind of an organization is the church? It's a nonprofit 501c3 organization, so they don't pay taxes on that.
They don't pay tax on
On their religious side, if they have business operations that they pay taxes on. Yes?
So how do you determine the value of the $15? The day that you donate?
Right, it's the day that you donated. Here's what used to happen, and they just changed it this year. I used to be able to go to, I have Charles Schwab and Vanguard and things like that, and I'd go, I want you to move, $1,327.42 from this fund to the corporation of the church at today's NAV. And it's, $1,000 for mission, $300 for tithing, or tithing, $300 for fast offerings, $200 for mission. And you could actually put a mission account for the account of Clinton W. Sudweeks, or, Clinton Sudweeks, But this year they kind of came out and they said, we can't do that anymore. So now you have to tell them, okay, I want you to move 1,327.5 shares. And then on that day, you just record, these were traded at this date, which was this price. And what happens is you'll send a fax giving them instructions. You'll also send a fax to the church, and then the church, 6 weeks later, you'll get a thing that says, okay, we received 1,327.5 shares of S&P 500, Charles Schwab S&P 500 index fund, SWPPX, or something like that. Okay, other things. Yes?
Can you buy a home?
Yeah, buy a home. You know what they say? You know what a house is? It's a hole in the middle of ground that you pour money into. But you can buy a home because the interest is deductible. Yes?
For buying a home, you have to live there for at least 2 years. Is that what it says?
Once you buy the home, you can get the tax deduction. But there are certain things about the capital gains.
That's the
Yeah.
advantage.
Yeah.
So.
Yes?
I liked your idea of the health savings account.
Okay, health savings accounts. And you could also do like we did, flexible spending. And health savings account used to be called flexible spending, and now health savings accounts, high deductible health savings accounts is a little bit different thing. Yes?
We were talking about these, and we couldn't really remember, but isn't there like a catch to those too? Where
Flexible
if you
spending,
don't spend the money by the
right,
end
you
of the
lose
year,
it.
Can you explain like what catches there are any like?
It used to be a lot more flexible, and the government has gotten a lot stricter with it. Like I said, this year they went from 5,000 down to 2,500. 2 years ago or 3 years ago, you could do toothpaste and contact lens stuff, and now they actually have to have records, the receipts on these things. So it's a lot stricter. But the nice thing again about flexible spending is you're paying for medical expenses with pre-tax dollars. And if you've got lots of kids like I do, I'd finished $5,000 within about July or August, and so I basically had a loan for 4 days, or 4 months until we finished paying the rest of it there.
Does it roll over?
It does not. Health savings accounts do. Flexible spending does. So you have to be careful on that flexible spending. But like I said, we've got 2,500, and we probably used 1,000 of that just this weekend, just for my kids with all the dentists and things like that.
Just to kind of respond to that, so, a financial planner was talking to me a little bit about it. He was saying you don't use this for like emergencies. You use these accounts for things that are expected, like
Right.
prescriptions you're going to have, or like the expected medicines
Right.
you're going to have, or even checkups you're going to have.
Agreed.
It's something you can predict.
Yeah, predict. And, Sudweeks' curse is bad eyes and bad teeth. So my kids all have braces. My kids all have contacts. Okay, other thoughts? So, contributions to retirement. Now, Jesse talked about a 401k. What's the difference between the 401k and the Roth 401k? So 401k, you get a tax benefit now. With a Roth 401k, do you get the tax benefit now? When does the tax benefit come? Yeah, when do you pay taxes on this again? Never. So that's a pretty cool vehicle as well. Okay, so Elliot. Employers may not have the Roth vehicle. Your employer may not have a qualified retirement plan, but if they do, you get to choose on the options that they have. Cassie.
So what would you suggest for us leaving college right away? I know that there's benefits like when you're going to be in a higher tax bracket, when you're in a lower tax bracket.
We'll actually spend a whole day talking about qualified plans and individual plans. My preference now, one of my strategies, my retirement strategies is I'm trying to put as much money in Roth vehicles as possible. Why is that? Why would I want to put money in Roth vehicles? Yeah. So what that'll allow me to do, if I have a chunk of money in traditional vehicles and a chunk of money in Roth, then I can actually not manipulate. I can manage my tax rate to minimize my taxes. And so the whole purpose of personal finance is making the best decisions and being the wisest stewards that we can be. And so if I have those vehicles, then I can kind of manage my tax rates. Again, the goal is to pay every dollar I owe and not a penny more. Okay, let's do it. Let's do a case. Okay, you got Matt and Janina, 40 and 42. They're filling out their 2012 taxes. 4 children, 3 under 17. Why is that important? Why is 3 under 17 important? Child tax credit, that's right. Contributed $5,000 to a traditional 401k, $2,500 to a flexible spending plan. They can only deduct medical bills above 7.5% of AGI and job-related expenses above 2%. Exemptions, $3,800 per person. Standard deduction is $11,900. Child tax credit is $1,000 per child under 17. Tax rates for 2012, I think that's a mistake, are 0 to 17.4, 10%, 17.4 here. So here's some information. They had earned income of $80,000, interest income of $10,000, home and mortgage interest is $68,000, unreimbursed medical expenses $7,000, unreimbursed job-related expenses, and tithes and offerings. So what we want to do, we're going to do married filing jointly. That's what this is here. Calculate their taxes using both the standard deduction and then the itemized deduction. And then I want you to calculate their marginal tax rate and average tax rate on gross income. How do we calculate your average tax rate? Total taxes paid divided by, and you can do it on taxable income, you can do it on gross income. Right here I'm asking it on gross income. And then your recommendations. Everything we do in this class has a recommendation here. So which way should they calculate their taxes? What could they do to reduce their taxes? Let's get back in our groups and spend 10 minutes. So remember what we start with? What do we start with? Gross income minus any deferrals or exclusions. And then we take that gross income, then we subtract out any adjustments. Okay. So maybe I'll just give a hint here. So first of all, what's their gross income? So what's first of all, what's their total income? Earned income and interest income? 90. So but what's their gross income? What's our gross income? 85, and why? So that 5,000 from the 401k is an exclusion. So now let's talk about what's their any adjustments to that 85 to that gross income. Any adjustments to that gross income? Oh, the flex spending. So what is their AGI? 8250. Okay, I'll let you kind of go from there. If you have questions, just raise your hand and I'll come around. Work in your groups, it's a lot easier. People in this class learn to sit next to the accountants.
Thank you for accountants.
And the MBAs too.
I know. I'm just saying.
ones that I use and the ones that I use. So I try to simplify as much to kind of
When you get your itemized deductions, I'm not really sure what it around.
and so that's kind of what I ask you.
So you're going along the lines of just probably help you instead of like trying to
Right, and what I do is every third year I have an accountant for me. And actually, like, I have, because I have K1s, so I got every Texas and I got a California K1, I actually have an accountant. We did it most of the time.
Cool. Oh, no. Oh, yeah.
Question, if you take the standardized deductions, are you allowed also to take the itemized deductions?
No.
So it's either one or the other. So you can either take that 11.9, or you can take the deductions that you calculate yourself. Okay. Are we almost ready to do it, or we want a little bit more time? More time, okay.
When I added to that, so that's like 1,005 or something. And I added on just the whole mortgage interest tied on it. That Well, it should be a difference between 2,000 and 62.
And then he does the
For the health, it should be in the neighborhood of 2,000.
That's so cool.
When I put in, I introduced in the HTML block.
Go into active tax return. Is it effective tax return? Well, it's usually 50%.
Yeah, that's what I got.
I mean, obviously they do that.
We had the same answers except I didn't have 22,000.
So I'm going to
Yeah. Oh, yeah.
I would much rather make
Well, the basic don't get directly from tax that you tax.
Okay, someone want to take us through this? In fact, let's do this. Can we get 2 volunteers? No one wants to volunteer? Should we do it as a class? Okay.
Make us feel better.
Okay. Our goal isn't here to embarrass people. Okay, someone want to take me through it? Let's start with the standard deduction. Eric, thank you for volunteering. I appreciate that.
I'm going to just look up your slides.
No, okay. That's all right. Just make sure you're ahead of me on the slides. And you know, you've got lots of people around you to help them. So someone help Eric. So first of all, what is our total? So our income from all sources is 90. What's our gross income?
85.
85, because we subtract out the deferral, and that gives us 85. How about what adjustments to get our AGI?
You've got your flexible spending plans, you want to take that off,
Okay.
and that gives you,
Okay. So what's our next step? So now that we've done that, then we take the greater of standard or itemized. Let's do it now with standard deduction. What do we do next, Eric?
take off your standard deductions.
Okay.
Yeah, that.
What do we subtract next?
Your children, I
Subtract. Is it just your children?
guess? In this case, yeah. No, it's an exemption, right?
Right. So exemptions.
I mean-
How many exemptions do we have here?
6.
6. Now, because the daughter, even though she's older, 17, but they're paying a majority of her expenses, do they get to include her?
Yeah.
Yeah.
Does that count for up until 18, or does it go over 18?
Over 18.
Just as long as, okay.
Yeah. So now we've got 6 exemptions, and that gives us our total amount of $47,800. How do we calculate our? So we've talked about income all sources, AGI, deductions, exemptions. Now we calculate that's our taxable income. How do we calculate our tax?
You gotta look at the tax table.
Okay.
So, I forgot the amount, but it's like,
The first 10% on the first 1740, then 15% beyond that.
yeah.
Okay. So now we've got 6,300. That's a pretty high tax. 6,300.
I don't want to pay that.
You don't want to pay that. Okay.
No.
So does this couple have to pay it?
They have children, so they can do credits.
Oh, okay. Tax credits too. 3,000. And so basically, total tax to a 3,300. Okay. Does that make sense? So notice that you get the exemptions regardless of whether you use standard or itemized deduction. Someone want to take us through the? Okay.
Okay, so we started once again just with our 82,500 AGI.
I'm trying to remember your first name. I'm sorry, I missed it.
Scott
Scott. Okay. Hatterley. Robinson. We got 2 Scotts here. Okay. Okay. So again, the same thing here. Gross income. AGI, same thing. Scott.
So then, I mean, I don't know what order you're going. We started with our medical expenses.
Okay. So now we'll do our deductions, medical expenses. Go ahead. Just tell me the ones.
So we took off 812.5. I think we might round with medical because it was a little more than 7.5%.
Okay.
We took off the job-related expenses of 350.
Okay.
Above 2%. Then we took off the full mortgage of 6,800.
Okay.
And then we took off the full tithing of 9,600. So we had about 64,938-ish after the itemized deductions.
Okay. And so. Okay. So what I did, I just added those 96 plus 6. So basically 17,563. And so we subtract that from our 82,550. Minus our exemptions. And what did you get for the amount?
So then we had, after the kids,
Yeah, after the
we
kids.
had 42,138.
Yeah.
Yeah.
Okay.
And so then we did, so you have your 1740 plus 15% of about 25,000. So we ended up having 5,451 in taxes.
Okay.
Take off the children again. So 2,400.
Okay. So now the recommendation here. A lot of the things we talk about in personal finance, there's room for opinion. With taxes, there's not. It's pretty cut and dried. So here, what was their marginal and average tax rate? Someone want to tell me what their marginal tax rate was? Pardon me? 15%. So it's the tax rate on each new dollar. So both the itemized. And then our average tax, we can actually do it. I asked for gross income. I could have asked for taxable income. But in the case here, they're paying 3.9% on gross income or 2.9% on taxable income. And so the question now is, which of these should they do? And how much would they save by using itemized versus standard? Yes?
Is that pretty typical? I mean, to think of making 90 grand and paying that little in taxes with the use of all those, different things. Is that typical, or is that kind of a rare case?
I think it's
pretty good.
a lot of it depends on how many kids you have. So when I have 7 kids, so there were many years that I paid very little taxes, very little federal taxes. Pardon me? Diapers, things like that. But yeah, so I think it's pretty typical depending on the number of kids you have. I know families now have fewer kids.
So businesses that have losses
Uh-huh.
carry those forward.
Correct.
Do individuals do that as well?
Right. So when I moved here to BYU, I had a bunch of mutual funds, and they were actively managed funds. And yeah, that's why I lost a lot of money. So I had a 6-month-old that had to pay taxes because the income from her funds were just huge. And so I got really mad, and I kind of sold all those at a significant loss. And then I bought index funds. But you're only allowed to deduct up to $3,000 a year of those losses. And so I have many years of those losses ahead of me. Carry forward, right. So you can deduct $3,000 a year on those losses. So recommendations. So the first recommendation, saved $849. If you can save $849, is it probably a good idea to spend the time? Yeah, I think it is. What could they do? What could they do to reduce their taxes? And we actually divide these up into different areas. More kids. Sometimes the tax benefit is but let's so there's actually 4 strategies that we recommend here. Number 1 is maximize deductions. What are some of the things we can do to maximize deductions? Yes?
Make sure you record these. I mean, we're just talking like there's a lot of deductions you can take, but you don't even realize it.
Okay.
Or if you do realize it, you don't know how much.
Okay.
So make sure you keep records of all those things.
So number 1, keep records. What things should we keep records? Donations to, you make donations to high school groups or things that are tax deductible. Donations for, United Way, Mothers Against, all of these things. How about in-kind donations to things like Deseret Industries or multiple sclerosis? Can you deduct those as well? How about donations to universities like BYU? My wife made a donation to BYU Hawaii. We're going to be sending a child there. Hopefully she gets in. But how about those things? Are those deductible too? So a lot of things. Home interest. Why home interest payments? Because you can deduct that. Why property taxes? Those are also deductible. Miles they drive to and from the charity. Again, scouts, young women's. Yes?
What about charitable donations where you get something back from fundraisers where, yeah, it's still a charitable donation, but you get click to go or whatever? Is that
Yes. So here's the thing. You have to figure out the value. How about Girl Scout cookies? You know what? When my kids were in Girl Scouts, we would buy 40 boxes. We were crazy. But you get something back. Generally, what the IRS wants you to do, determine the value. You make a donation of $50, you get a $10 ticket back. So you can't deduct the whole $50, but you can do $50 minus the value of the ticket. And then you get to determine that. Non-cash contributions, donations, Deseret Industry, Goodwill. Keep good records of those. When you drop those off, the most important thing is that receipt that you get. Now, you have to decide how much that value is worth. Again, if you have appreciated financial assets, you can contribute those to charity instead of cash. Reduces taxes paid, increasing deductions, and eliminating capital gains tax. So those are some ideas. Let's go to number 2. Minimize taxes owed. How could you minimize taxes owed? When you invest, you choose your taxes, you choose your fees. Could you make wise choices on your investments? You don't invest in mutual funds that have a lot of distributions. So you don't have the problem of a 6-month-old having to pay taxes. So you can be wise. A passive strategy, purchase low turnover mutual funds that basically have very low distributions. Ideally, what you want to do is you want to move as much of your taxes into capital gains as you can. We'll talk about these in class. If you invest in stocks or stock mutual funds, stock dividends are taxed at a preferential rate. A 15% versus bond interest at your marginal tax rates, and marginal tax rates are going up. Capital gains taxes are going up. So if we can minimize taxes, and a lot of this is investment and retirement planning, and we'll talk about each of these areas. Here's a third area, receive tax-exempt income. What is this? How do you receive tax-exempt income? What's tax-exempt income? Yes?
There's things like muni bonds that you don't have to pay federal taxes
Muni bonds,
on,
they're federal tax-free. Do you still have to pay state tax on them?
depending on
Yeah.
some of them,
Yeah, you still have to pay state tax unless they're from you're from the state where the securities are issued. Flexible spending plan, that's tax-exempt income. The investments, municipal bonds, federal tax-free for interest, or treasury securities, which are state tax-free for interest. And how do we defer taxes to the future or eliminate taxes? Since we only got 5 seconds left, qualified plans at work, you can contribute to a 401k or a 403b. If you have children, you can contribute to a 529 plan or an education IRA. No taxes now, but eliminate future taxes. If it's available, you could use a Roth 401k or a 403b to kind of defer taxes. Bottom line, the Lord wants us to pay all the taxes we owe and not $1 more. Through being wiser stewards, we can reduce the amount of taxes owed. Thanks, everyone.